Welcome back to The Explainer. For all you focused learners out there, strap in. Because honestly, looking at today's market breakdown, it feels less like standard finance and way more like some high-stakes, vibrant anime battleground. It's August 18th, 2026, and the crypto markets are currently locked in what we're calling the ultimate prove-it phase. We've got major resistance levels being tested, massive institutional power shifts, and these looming macroeconomic boss fights all colliding at the exact same time. To really get a feel for the frontline atmosphere today, you just have to look at the current fear and greed index. We are sitting at a score of exactly 41. That puts us squarely in fear territory. So despite some recent upward price action we've seen, there's this intense, incredibly cautious tension hanging over the crypto market right now. It's kind of like staring down a looming opponent, just waiting to see who blinks first. And all that tension leads us to the central conflict of our explainer today. As Bitcoin reclaims a crucial price level, this is the pivotal question on literally every trader's mind. Is this a durable recovery that we can actually trust, or is it just a fleeting relief bounce before the market rolls right back over? Let's find out. Section 1, the 64K Bitcoin Battleground. Let's dive into this. Okay, so our first major clash is Bitcoin's intense fight to hold that $64,000 level. And man, the sheer weight of the opposing forces sizing each other up right now is wild. On the bullish side, Bitcoin bravely pushed back into the recovery zone, and we're finally seeing ETF demand reverse into positive territory. But look at the heavy macroeconomic headwinds staring right back. We've got U.S. 10-year Treasury yields spiking to 4.73%, and Brent crude oil hitting $91 a barrel. When safe yields are that high and energy costs are rising, it acts like financial gravity, pulling capital completely away from risk-on assets like Bitcoin. So the absolutely crucial point here is that just briefly touching 64K, yeah, that's not enough to declare victory. To confirm a true recovery and not just fall victim to a relief bounce, Bitcoin has to survive a strict three-step sequence. Step 1, which it actually achieved, is moving above 64,000. But step 2 is surviving the inevitable pullbacks. It needs to spend actual time above this area instead of just immediately slipping back down. And step 3 is turning that former heavy resistance into solid support. If it fails to hold this ground, well, the bears take back control. Moving on to section 2, spot ETFs and institutional reversal. You know the golden rule in crypto, right? To know who's winning the battle, you have to follow the money. And the recent data tells this intense micro-story about institutional panic versus institutional conviction. Last week, we saw a massive retreat. Nearly $390 million bled out of U.S. spot Bitcoin ETFs. It genuinely looked like institutional money was abandoning the front line. But then, Monday, August 17th hit. We saw a sudden, decisive reversal, with net inflows reaching somewhere between $137 million and $298 million. Institutional money abruptly held the line and bought the dip. It's a fantastic sign of resilience for sure, but remember, one day of inflows doesn't win the war. We need to see a sustained trend. But listen, if you really want to know where the heavy institutional momentum shifted last week, check out this staggering power move. While Bitcoin was bleeding that $390 million, U.S. spot Ethereum ETFs recorded a record-breaking $2.85 billion in net inflows over the exact same period. That's billion with a B. Ethereum demand completely eclipsed Bitcoin. That level of conviction shows institutional players are dropping heavy anchors into ETH's long-term value proposition. All right, section 3, Ethereum's evolving 2026 roadmap. Now, this insane surge in Ethereum's institutional flow isn't just happening in a vacuum. It ties directly into a massive structural evolution happening right at the base layer. The Ethereum Foundation officially shifted their timeline. Right now, they've just launched the Plato-Burget public testnet. This is basically the proving ground for the highly anticipated Glamsterdam upgrade, which is now targeted for late 2026. What we're witnessing here is a major strategic pivot towards strengthening Layer 1 performance right alongside their ongoing Layer 2 scaling efforts. A really huge piece of these upcoming upgrades is focused on improving Layer 1 execution capacity and integrating native account abstraction. Let's translate that, because it's an absolute game changer for the network. Essentially, this means making the base layer much, much faster and allowing smart contracts to act as wallets. Why does that matter to us? Because it drives massive long-term value accrual for the network, provided these new testnets actually stay stable. It's the architectural foundation that all these institutions are betting on. Meanwhile, jumping over to the altcoin arena, things are pretty fragmented. The altcoin season index is sitting at 46. So no, we are definitely not in a massive market-wide alt season where everything goes up together. Instead, capital is hunting for very specific narratives. We're seeing selective rotation into tokens like Compound, which jumped 10%, and VVV, which rose 12%. Bottom line, if you're playing altcoins right now, narrative is quite literally everything. Section 4, Macro Forces and Looming Threats. Let's zoom out for a second, because no matter how strong crypto's internal fundamentals are, it absolutely cannot escape the formidable macro boss fights brewing in the global economy. These are severe geopolitical and economic threats acting as gravity against risk assets today. We've got stalled U.S.-Iran negotiations and maritime tensions just exploding in the Strait of Hormuz, highlighted by the recent seizure of a UAE oil tanker. That geopolitical friction caused Brent crude to surge to $91 a barrel. And when oil spikes, inflation fears return, which drives up our final point here, the U.S. 10-year Treasury yield sitting at a painful 4.73%. Capital simply isn't going to flow freely into crypto when global uncertainty and risk-free yields are sitting this high. But hey, it's not all doom and gloom on the macro front. Contrast those geopolitical threats with this crucial relief signal. Goldman Sachs just reported that a September Federal Reserve rate hike is now very unlikely. U.S. consumer data is softening, and inflation is cooled enough to basically take the immediate threat of further rate hikes off the table. This falling rate hike probability, it's exactly the supportive backdrop the crypto bulls need to mount their defense of that $64,000 level. Next up, Section 5, Washington's crypto policy push. Let's pivot from monetary policy over to the regulatory front lines, because upcoming political catalysts could dramatically flip the balance of market power. Right now in Washington, the highly anticipated Clarity Act remains totally stalled in Congress. Because of that gridlock, we're seeing direct political action step in. President Trump has a scheduled meeting tomorrow, August 19th, with crypto and Wall Street leaders. They're meeting to discuss either pushing this legislation through or potentially authorizing independent rulemaking by the SEC and CFTC. Regardless of your politics, the outcome of these policy pushes will absolutely dictate the next era of institutional crypto adoption. Which brings us to Section 6, Surviving the Prove-It phase. So, how do all these conflicting macro, institutional, and regulatory forces actually collide? Well, this quote from the KuCoin Daily Market Report pretty much hits the nail on the head. They say the market is likely to remain in a range-bound recovery phase in the near term. And that makes total sense, right? Despite the high-energy battles over 64K, those massive Ethereum ETF inflows, and those looming macro boss fights, the market is currently locked in a tense, sideways stalemate. The bulls have just enough ammo to prevent a collapse, but the macro headwinds are just too strong to allow a parabolic breakout. We are completely range-bound. Which leaves us with one final provocative thought. We know the battlefield. We see the forces at play. But on August 20th, the Federal Reserve will release their crucial FOMC minutes, and that could instantly shatter this stalemate. So, I pass the question to you. How are you positioning your portfolio for the impending volatility? Are you waiting for Bitcoin to finally prove it can hold 64,000? Or are you following the institutional money right into Ethereum's structural evolution? Think about it, apply what we've covered today, and stay focused out there. I'll see you on the next explainer.